Friends, welcome once again to our session today. Is your host none other than Mr. Spotter Fred. Now, friends, from our previous sessions, we have been looking at accounting for branches, and we have looked at the types of branches. We have remained with one more to go. So today we are still going on with the branches, accounting for branches or branch accounting. Accounting for branches. From our previous sessions, friends, we must have talked about branches, that large organizations will sell their goods and services through various outlets, and these outlets are known as branches. We have three types of branches. Remember, we have talked about the types of branches before. Types of branches. We have the types of branches. There are three. We have one, or A, is dependent branches. We have dependent branches. We also have the B, we have independent branches. We have independent branches. Then we have C, there is foreign branches. Foreign branches. Now, from our previous sessions, we have discussed widely the dependent branches. We have also discussed widely independent branches. Together with an illustration for each, we have done an illustration for dependent branches, an illustration for independent branches as well. Now, friends, when it comes to foreign branches, so we want to talk about the foreign branches. In the foreign branches, will be, the branch, an organization may have a branch outside the reporting country. For example, we may have a branch in Uganda, we have a branch in Tanzania, we have a branch in Rwanda, we have a branch in another country, in a foreign land. All the transactions of this branch will be reported in the foreign currency. That foreign currency that will be reporting those transactions will be the functional currency. Now, our business will be required to translate the foreign currency transactions to the reporting currency. Then we prepare the financial statements as required. Now, according to IAS 21, we are going to use the IAS 21. There are two methods which can be used to make the translations. So according to IAS 21, that is foreign currency, foreign currency translations. There are two methods which can be used, and these methods are one, we have the functional currency method, and two, we have the presentation currency method. The functional currency method can also be referred to as the temporal currency method. We can also, presentation currency method can also be referred to as the closing rate method. Now, as a summary, in summary, when we talk of the functional currency method, then you should remember items will be translated as follows. One, let me say the items. One is non-monetary items. Here we are talking about non-current assets. We are talking about property, plant, equipment. We are talking about motor vehicle. So non-current assets, we use the historical exchange rate. This is the exchange rate prevailing at the time when the transaction took place, the historical exchange rate. The exchange rate prevailing when we purchased that particular asset, that is our historical exchange rate. Then number 2, we talk about depreciation expense and provision for depreciation. Depreciation expense will also be translated using the historical exchange rate. This is the exchange rate prevailing when the transaction took place, whether is when we purchased the asset or when the asset was revalued. So the historical exchange rate. Now we also have these other items: current assets and liabilities. We use the closing exchange rate. Remember, the closing exchange rate is the exchange rate prevailing at the balance sheet date. If, for example, we are preparing our financial statements as the 31st December 2015, then definitely the exchange rate, the rate prevailing as the 31st December 2015 is our closing exchange rate. Then we also have number 4. We have the profit and loss items. When we talk about profit and loss items, we exclude the depreciation expense under this method, because depreciation expense is a profit and loss item, but we use the historical exchange rate. So you come and say this one is the average. This is the average exchange rate. If the average exchange rate is not given, you simply take the opening exchange rate at the beginning of the year plus the closing exchange rate at the end of the year, you divide it by 2. So you get the average exchange rate. Then we have number 5, the remittances. At the branch. The remittances at the branch will be translated using the actual amount. So we say use actual amount at the head office. So this is what we are talking about. You use the actual amount prevailing, meaning you ignore the remittances at the branch. Instead, you use the remittances reported at the head office, because they should be opposite and equal to each other. Then from there, because of space, the next item is head office. Head office current account. The head office current account will be translated using use the actual amount at the head office. What does that mean? It means that you ignore the head office current account balance. Instead, you use the branch current account balance. Then lastly, or finally, we talk about exchange difference. Friends, exchange difference will be reported as either a gain or a loss. Or a loss in the income statement. So we are going to recognize it as a gain or loss in the income statement. We also talk about the presentation currency. The presentation currency, friends, is whereby we have the item and we have the rate. This one, all balance sheet items, we use the closing exchange rate. To all profit and loss items, we use the average exchange rate. 3, remittances, use actual amount at the head office. 4, we have head office current account. Use actual amount at the head office, meaning if you're using the actual amount at the head office, for the head office current account, it means that you use the branch current account balance instead. And finally, we talk about the exchange difference. The exchange difference will be translated, or rather will be reported as movement in equity. The exchange difference will be reported as movement in equity, and that is under capital and reserves. So that's a summary of what you should remember when it comes to foreign branches. Now, you need to remember that when we have a question or we need to do the translation, we need to choose the method. Is it functional currency method or is it presentation currency method? For presentation currency method is mainly made for presentation purposes, but for the functional currency method is meant to translate the home currency, to translate the currency to the reporting currency, that's the home currency. So we'll always use the functional currency method unless you're told to use the presentation currency method. So we'll be using the functional currency method. There are some of the steps that you need to remember. Steps. Now, step number 1, you need to do the necessary adjustment. Do necessary adjustment using the additional information provided. Use the necessary, do the necessary adjustment using the additional information provided. Step number 2, choose the method to use. Choose the method to use and translate. And translate all items. You translate all items to the reporting currency. Step number 3, you'll be required to determine, after you have translated, you determine the exchange difference. Determine the exchange difference as a balancing figure. From the translated trial balance. Then 4, use the reporting currency to prepare the financial statements. You know, we can easily say carry out the necessary adjustments after translation, e.g. determine the combined closing stock and cost of sales. Then 5, prepare the financial statements either individually or on a combined basis. So that's exactly what you need to do. You need to do the necessary adjustment. You translate using the required method. You determine the exchange difference. Then you carry out the necessary adjustment after translation, like determining the combined closing stock and the combined cost of sales. Then you prepare the financial statements either individually or on a combined basis. Now, one thing you need to remember, the exchange difference. What is an exchange difference? You have really used it severally. An exchange difference is simply a difference that will arise when units of one currency are translated to units of another currency using several exchange rates. That is our exchange difference. The exchange difference is the difference, I repeat, the difference arising when units of one currency are translated to units of another currency using different exchange rates. That's perfect. So that's what we should know about the exchange difference. Now, after we have said this, friends, we need to move on and look at an illustration question. We need to look at an illustration question. There is an illustration question that was attempted, that was rather examined in some years ago. That is May 2012, question 5B. May 2012, question 5B. So there is May 2012, question 5B. That is, Elgon Limited, a manufacturing concern, exports some of its products through an overseas branch whose currency is the mil. The reporting currency of Elgon Limited is the Kenya shillings. The overseas branch carries out the final assembly for the products before the goods are sold to customers. The trial balances of the head office and the overseas branch as of 31st March 2012 were as follows. We have been given the head office, we have been given the overseas branch. There's accounts receivable, stock payable, there's a freehold billing or at cost, we have revenue, we have ownership capital, we have the components we have sent to the branch, we have the head office branch current accounts, we have the branch cost of sales, we have the head office cost of sales, including goods to branch. We have the provision for depreciation, that's for machinery. We have inventory as of 31st March 2012. We have the administration expenses. We have the profit and loss account. We have machinery at cost. There's remittances, there is bank balance, selling and distribution costs. Friends, remember, the head office is in Kenya shillings, while the overseas is mil, thousands. Additional information 1. The administration expenses for the head office and the overseas branch include depreciation charge of 10% per annum on cost for machinery. 2. On 28th March 2012, the branch remitted 40 million mil, which was received by the head office on 2nd April 2012 and realized 49,75,000. 3. A provision of 750,000 Kenya shillings for unrealized profits on the branch inventory is to be made. 4. During the month of February 2012, a branch customer in error paid the head office for goods supplied by the overseas branch. The amount due was 800,000 mil, which realized 90,000 Kenya shillings. The amount was correctly accounted for by the head office. No entries had been made in the branch books to reflect the transaction. 5. The prevailing rates of exchange were as follows. As at 1st April 2011, we have 1 Kenya shillings is equals to 10 mil. As at 31st March 2012, we have 8 mil is equals to 1 Kenya shilling. We have average for the year, 9 mil is equals to 1 Kenya shilling. Then we have on purchase of buildings and machinery, 7 mil is equals to 1 Kenya shillings. Required 1, branch translated trial balance as at 31st March 2012. And 2, head office and branch income statement in columnar format for the year ended at 1st March 2012. 3, combined head office and branch income statement of financial position as at 31st March 2012. Now, from the required point of view, friends, we have been told to do the translated trial balance. Then we have also been told to prepare the head office and the branch income statement in columnar format. But for revision purposes, we're also going to do the combined business. Apart from doing the head office branch, we also do the combined business income statement. In our required number 3, we have been told to prepare the combined head office and branch statement of financial position. But for the purpose of revision, we are going to do the statement of financial position for the head office, for the combined business, and as well for the branch, the head office, and for the combined business. That's what we're going to do. From the required point of view, you also realize that we have been told to prepare the financial statements for the year ended at 1st March 2012. And don't forget this. If we have been told to prepare the financial statement for the year ended at 1st March 2012, then it means that our year begins on 1st April of the previous year and ends at 1st March of the current year. So we are talking about our year beginning 1st April 2011 and ending on that 1st March 2012. Now, from what we have been given, from additional information, let's go to additional information. One, the administration expenses for the head office and the overseas branch include depreciation charge of 10% per annum on cost for machinery. One thing you need to remember, the depreciation in that case has already been accounted for. It has already been calculated, but included in the admin expense. There's no problem with that. Depreciation can even be included as part of cost of sales, as part of distribution cost, and as part of admin expense. So they have told us that they had accounted for this depreciation. They have calculated it and recognized it as part of admin expense. They must have debited the admin expense and credited the provision for depreciation. So it's already included. Our business there is for the purpose of translation. We need to determine the exact depreciation. We exclude it from the other admin expenses so that we are able to translate, because you know that using the functional currency method, the depreciation expense will be translated using the historical exchange rate, while the other admin expenses will be translated using the average exchange rate. So there's no problem by combining them, but later, for the purpose of translation, we need to separate the depreciation expense from other admin expenses. We are going to do that. Number two, on 28th March 2012, the branch remitted 40 million, which was received by the head office on 2nd April 2012 and realized 49,75,000. So this cash has not been received. Some cash has been sent, but they have not received it. They have not received it at the head office. This means that at the balance sheet date, this is a cash in transit. Now, the cash in transit has already been translated to the Kenya shillings. That is 49,75,000 being the reporting currency. So we are going to recognize this as a cash in transit, and it will help us immediately after translation. But you also need to remember that one of the items included in the remittances is the cash in transit. Remember the remittances of the overseas branch. They have already accounted for this cash in transit. They have sent the cash, is only that the head office has not received it. So the 4975, which is in mil is 40 million, is already included as part of the remittances of the branch. But it has not been recognized as part of the remittances of the head office. So for the purpose of determining the actual remittances of the head office, we must take the remittances being in the trial balance of the head office. We are increasing it by 49.75. That's important. Then we have been told, number three, a provision of 750,000 for unrealized profits on the branch inventory is to be made. So there is a provision, and 750 will be adjusted accordingly to our income statement of the head office and to our branch current account balance to determine the net realizable value. Number four, that's different. Number three is after translation. Number four, during the month of February 2012, a branch customer in error paid the head office for goods supplied by the overseas branch. The amount due was 800,000 mil, which realized 90,000 Kenya shillings. The amount was correctly accounted for by the head office. No entries have been made in the branch books to reflect the transactions. Friends, this is the position that the branch sold some goods to a customer, and they sold them on credit. Instead of the customer, to pay directly to the branch, they instead paid to the head office. So the head office received money from a branch customer on behalf of the branch. I repeat that statement. the head office received money from the branch customer on behalf of the branch. So what do we do? The head office, once they received, they should or they must have debited the bank account and credit the branch current account. That one we have been told that it had already been done correctly. So the head office accounted for that correctly by debiting the bank account and crediting the branch current account, that this money we have received it from the branch customer. But at the branch, it has not been reported. So what we do, friends? Now, because the head office had accounted for that correctly, the branch has not accounted for that. Then it means the debtors of the branch is overstated by 800,000 mil. And it means that the head office current account balance is also overstated. This is the reason behind. The customer paid this money to the head office directly. So the debtor's balance must be reduced. Because this money was received by the head office on behalf of the branch, then we must reduce our head office current account balance by what they have on our behalf. So that's exactly what we are going to do. So we reduce the head office current account balance by 800,000 mil, and we also reduce the debtor's balance by the same amount, 800,000 mil. That's exactly what we're going to do. Then we have been told, number 5, the prevailing rates of exchange were as follows. We have, as at 1st April 2011, that's 10 mil is equal to 1 Kenya shilling, and that is our opening exchange rate. It may not really help us. It may only be used if there's an item we purchased on 1st April 2011, or if we are not given the average exchange rate. If there's an item that was purchased on 1st April 2011, then that will be our historical exchange rate. Or there's a transaction that took place on that date, that will be our historical exchange rate. And if we are not given the average exchange rate, then we take the opening exchange rate plus the closing exchange rate, we divide by 2 to get the average. But with this one, we were given the average exchange rate. So our opening exchange rate may not have any use there. As of 31st March 2012, the exchange rate was 8 mil is equal to 1 Kenya shilling. Now remember, as of 31st March 2012, that's the closing date. That's our balance sheet date, meaning that's our closing exchange rate. So the closing exchange rate will simply be used to translate the current assets and liabilities. Apart from that, it may also be used to determine the average exchange rate by taking the opening exchange rate plus the closing exchange rate. Like in this case, we could take 10 plus 8 divided by 2, we could get 9. And the 9 we were given, so we don't need to bother with it. The average exchange rate is 9 mil for 1 Kenya shillings. On purchase of buildings and machinery is 7 for 1 Kenya shilling. That is our historical exchange rate. When we purchase the buildings and when we purchase the machinery, that is our historical exchange rate, which will be used not only to translate the current asset, but also to translate the depreciation and provision for depreciation. Now, on that note, friends, we need to do the translation. We need to do our step number 1, step number 2, and step number 3 can be done at the same time. 1, 2, 3, we can do it at the same time. So I need to make some space for that. We simply talk about foreign branches. But you cannot have only foreign branches without local. So we have the local, independent local, and foreign branch. We are talking about a question that was set in May 2012, question 5B. So we want to answer the first one, the translation of the trial balance. So we have the overseas trial balance. As at 31st So we can come and say that this is the debit and this is the credit for this is for overseas for the mil thousands. We want the adjusted. This is the adjusted trial balance. This is the adjusted trial balance in respect to step number 1. Then we are going to translate them using the rate. Then this will be the translated trial balance. This is the debit and this is the credit. This time round, friends, this is in Kenya shillings. This will be in Kenya shillings. We'll definitely use the functional currency method. Now, we definitely use the functional currency method. Now, first and foremost, we need to recognize those items in the trial balance. One of them is the accounts receivable. Accounts receivable. Accounts receivable, remember friends, it need to be adjusted. Now, accounts receivable for overseas branch, friends, is 90,000. But you need to remember that there is a client or a customer who had paid, but these had not been adjusted in the books of the branch. So we have the 90,000, then you subtract the amount the client had paid directly to the head office, which is 800. You subtract the 800, we get 89,200. That's in mil. The creditors or payables, we have accounts receivable. Let me say accounts receivable or accounts, we have accounts payable. Accounts payables, that is does not have an adjustment, 3,900. Then we talk about the freehold billings. Freehold billings. At costs, which is 157,500. We have revenue. Revenue, we have it as 260. No, that is for the head office. For the branch is 1,080,000. We have components, we have heads, branch current account or head office current account. The head office current account is 1,260. 1,260, 650. Branch cost of sales. Branch cost of sales is coming to 868,500. We have been told about head office cost of sales. That's okay. We are talking about provision for depreciation. Provision for depreciation, we have it as 141,750. Apart from that, we have inventory. Inventory is 28,800. We have admin expenses. Now, admin expenses includes depreciation expense for the year. So let's recognize pure admin expenses. Admin expenses, we take the one that is 76,500. We subtract the depreciation expense for the year, that is 10%. The depreciation expense is 10%. 10% on the machinery. Machinery at cost is something to do with that 315,000. So if you take 10%, 10% of 315,000 is definitely 31,500. Then we have the depreciation expense.